Hey everyone, welcome back to Corporate Dakota, the place where we sift through the corporate gobbledygook so you don't have to. Today we are diving into Terra Property Trust's latest quarterly report. This one's got a surprising twist. It looks like they are actually ozzing money, despite all the talk about real estate being a gold mine. We're going to break down where it's going wrong and why, so stick around. But before we get started, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Join us. First off, this is a Form 10Q, which is a quarterly report that public companies have to file with the SEC, the Securities and Exchange Commission. Think of it as a snapshot of the company's performance and financial health for the past 3 months, in this case for the quarter that ended in March of 2025. One key detail is that Terra Property Trust had about 24.3 million shares of Class B common stock outstanding as of May 9, 2025. No active trading market has been established for this class of shares, which is something to keep in mind. It is important to remember that these are Class B shares and no market value has been determined, so keep that in mind as we talk more about this company. Now, let's navigate through this report. We'll hit the highlights focusing on the financial statements and what they tell us about Terra Property Trust. Don't worry, we will not be going through all these points like a robot, but we will look for key and important details to focus on. Here is the consolidated balance sheets, which gives us a snapshot of what the company owns, its assets, and what it owes, its liabilities at a specific point in time. Let's compare March 31, 2024 to see what's changed. The company's cash and cash equivalents increased from $8.6 million at the end of last year to about $11.9 million March of this year. So that's a pretty good thing. But let's look at the other side to see how they are doing. Total liabilities decreased from roughly $357.1 million to $315.3 million. It looks like the company has more money but less debt. Let's see if the company can keep this up. Now let's dive into the consolidated statements of operations and comprehensive income loss to understand how Terra Property Trust made its money and where it struggled during the last 3 months. Interest income, which is a primary source of revenue for a company like this, was about $10.20 million, down from $12.1 million as in the same period last year. So it looks like this is going in the wrong direction. We're looking more closely into the cost. Total expenses decreased by about $1.8 million from $10.20 million to about $8.4 million. The decrease in expenses were not enough to outweigh the revenue decrease. However, here's the bottom line. Terra Property Trust reported a net loss of $1.3 million for the quarter, compared to a $6.2 million loss during the same period last year. This means they're still not making money, but they are losing less money than before. It's like slowing down when you're driving towards a brick wall. The loss per share, which tells you how much money the company lost for each share of stock, was $0.050 against $0.25 last year. One thing you might be curious about, they declared distributions of 0.19 per share. This is a distribution from money they previously held and were not earned through normal operation. Other comprehensive income loss had a gain on available for sale. Debt securities of $145,735,772.10,782 last year. Next up is the cash flow statement, which shows how cash is flowing in and out of the company. This is always important when talking about companies that have losses, as we need to understand if they can stay afloat. Net cash provided by operating activities, or the cash generated from the company's day-to-day business, was $0.9 million, compared to cash used in operating activities of $4.2 million last year. As we said before, the company seems to be slowly turning around after looking at some of these numbers. Net cash provided by investing activities, which includes things like buying and selling investments, was $46.2 million, compared to $33.4 million. They're making more money on day-to-day business, but also with investments, it seems. Net cash used in financing activities, which includes debt, equity, and dividends, was $45.9 million compared to $22.2 million last year. So they're attempting to use the cash they have on hand to pay these out. That is why their shares offer a high dividend yield. Count with those numbers, it looks like cash increased, but let's make sure. Cash increased $1.2 million this year versus an increase of $7 million last year. They managed to end with more cash overall, which is important when the operations are at a loss. Let's peek at the notes to the financial statements, as these often provide additional context and details about the numbers. This is like reading the fine print. The company elected the practical expedient under ASC 326 to exclude accrued interest from amortized cost, which basically means they're not counting interest they think they'll receive, just what's actually coming in as of right now. Accrued interest receivable was approximately $6.1 million and $544 million. You always want companies to be realistic, so that's nice to see. It appears the company takes a model-based approach to estimate how likely they are to actually get all of their money. This is tricky stuff, as it means the company has to guess at future losses, something very hard to do. Some of the items they look at is historical data, the loan or property, including current market conditions, asset-specific conditions, property operations, or borrower. Some sponsored details and more. The company might invest in debt securities, but they are classified as available for sale debt securities and are carried at fair value. This is a good thing as it helps reduce risk to have the investment diversified. The company uses a market-based approach to value its assets, which means looking at what similar assets are selling for in the market. The company uses different levels to measure the value. Level 1 is the most trusted, and level 3 is based on what they think the investment is worth. The company has authorized 50 million shares of preferred stock, but none have been issued for now. The big one to know is the discussion on summary of significant accounting policies. This note is very important for auditors and it goes over how the company approaches accounting. A large part of this is how they determine allowance for credit losses or estimate recoverability of loans for both loans in default and ones that are up to date with their payments. This is critical to understanding the risk with the trust. They are talking about new updates to accounting rules for segment reporting and income tax disclosures. The income tax should make it easier to see what their profits are. The company's investment activities are externally managed by Terra REIT Advisors, LLC, the manager. It's a subsidiary of the company's sponsor, Terra Capital Partners, LLC. There are related fees and agreements for this partnership. Fair value on loans and secured financing agreements are estimated through a few techniques, mostly related to risk ratios. It appears the company also has a 5-point scale that assesses the risk factors of the business that takes into account a couple factors, our sponsor capability, DOF, loan performance cal, collateral, cash flows, loan to value. There is a summary of income for equity, but not much in the way of big information or standouts. The company has some commitments, but they say that they will have sufficient money on hand to cover them through operations and drawdowns. One particular area to pay attention to is the section on related party transactions with Terra REIT Advisors, because this can lead to conflicts of interest. After all, they're paying themselves. Finally, the discussion on debt has the expected table of payment types and schedule of dates with notes on secured financing. They mention that from time to time they may be a party to some legal proceedings and they do not expect it to affect the company, which is good. And finally, factors impacting operating results. This is important because they talk about what can change their company, like AltServe, volatility, ASI financial conditions, Alpor management team, Shefton El Cavu, other government regulations. Alpine Walnuts pull out to see what it all means. In summary, the earnings are not great. It looks like we are going in the wrong direction on that front with operations and revenues. Some of the key points are that expenses are down, but they are making less money to counteract that, which led to a loss of 1.2 million. In comparison, the loss last year was about 6.2 million. True, there are also new potential red flags relating to related party agreements between Terra LLC. Overall, the results were mixed, more negative than positive, but perhaps there is a way to turn things around. So, what's our take? The company needs to improve its revenue generation to become profitable. They are losing less money, but still losing money. They need to fix this in the long term. If they can't, some red flags may arise. One of the company's biggest strengths is the diversity. The trust is making attempts to mitigate the risk associated with their business, and hopefully they can pull through DOFRL, are losing less money, but still losing money next to mitigate the risk associated with their business. And hopefully they can pull through. Overall, the management team has a big job in front of them to address all the market force and regulations. Alright, that's our breakdown of Terra Property Trust's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.